As we approach the walls of the fiscal house, I think there's a very simple concept that does a really good job explaining the types of investments that we're looking for specifically within the walls of your fiscal house. So the concept is that of capital structure. So let's say we have a company XYZ. There's different ways that you can own that company. Number one, you could own the common stock of that company. Okay? The common stock, you may be familiar with that term because that's what you see, that's what's in the roof. It moves on the public markets. On top of the common stockholder, you have the preferred stockholder. Okay? Preferred stock is exchanging a lot of the movement of the market or the growth of the market in exchange for better dividends or better income. On top of the preferred stock, you have the investors that are the debtors. These are the ones that buy the debt of a company. They hold the bond of XYZ. On top of this, the bondholders, you have the senior secured debt holders. Just like the bondholders, that company has an obligation to them. The difference is that when you invest in senior secured debt, you're essentially telling the company, you can invest my money, but if you go bankrupt, if you don't pay me back, I own your building. I own something that is going to be secured in the assets column of your balance sheet. And then on top of the senior secured debt holders, you have the creditors. These are people who have some level of a contract between you and the company that you're invested with. So as we apply this specifically to the walls, understanding that preferred stock is a good way to put yourself above the common stockholder, but what you're really doing is you're removing a lot of the volatility in exchange for a better dividend or a better income from that investment. Also, we look at what we call tactical bonds. One thing we don't want to be with bonds, especially in today's interest rate environment, is passive. Interest rates are very low, and the Fed is essentially committed to raising rates. Okay, so if you own a bond in a rising interest rate environment and you were to sell that early, you could potentially lose money in that process. We also look at opportunities in private equity. Private equity is having equity ownership of a private company versus a public company like you might find in the roof of the fiscal house. We look for opportunities, as we said before, in senior secured debt. All we're trying to do is put you higher on the totem pole here, put you higher on the capital stack. And here, you actually own debt of a company, but it's secured by something in the assets column of their balance sheet. And then finally, to put you in the creditor spot, there's really good opportunities in opportunistic real estate. Now, not all real estate is created equal. There are certain sectors that we like, there's certain sectors that we don't like. Always important to focus on something that's going to be more necessity-based. So we're not so much interested in owning golf courses or malls or strip malls or things like that, because in a bad economy, those places suffer first. But otherwise, we like opportunities in necessity-based real estate. That could be real estate in healthcare. That could be multifamily. Got to put a roof over your head. It could be opportunities in grocery-anchored real estate.
The overarching point is this: it's all about the insulation. It's all about the insulation. It's about moving you up that capital stack as far as possible at the top of the food chain, because it's about protecting you. Making sure that your lifestyle isn't dependent on what the roof does and what the markets do. And that's why not only do we diversify in the roof and the foundation, but also especially in the walls with preferred stocks and private equity and opportunistic real estate, we get that insulation and durable income.